Hi, my name's Phil Dalrymple. I'm a shareholder at RandA CPAs. I work primarily in financial reporting and assurance, but I'm also a certified fraud examiner. I really appreciate everybody who's come out to attend today. They've given me a script. We'll see how well I can follow it. My shareholders would say, I don't think he's going to get it all in. I want to start a little bit with thanking our partners on this event, Pima Community College and Focus HR. This has been a joint effort to bring this content to you today, and we hope that you really get some value out of it. Our goal is to help you grow in your skills that focus on year-end financial reporting, and to also to look at ways to manage payroll costs for your business and for your firm. So we have a survey that will help give you that opportunity to give that feedback and input, and we hope that you take the time to help us with that. I'd like to introduce Jed Lightcap. He was instrumental in getting this done for RandA. He's a tax manager and also works in our client advisory services area and helps run that with Allison. And Jed, why don't you come on up and introduce yourself and get this thing rolling.
My name's Jed Lightcap. I'm a tax manager at RandA CPAs. Married, 3 beautiful kids. RandA CPAs, we've been around for 70+ years. We're about 50 big. Definitely during tax season, we're definitely 50 big. We have a lot of resources, and that's pretty much the only marketing piece I'm going to give today. We have really highly qualified, very competent people. I'm very excited to be working at RandA. All right, so I'm an accountant. This is my day job. I'm talking to about, 50, 60 people, and I hope you guys feel entertained and jazzed, and you're like, I'm going to take this back, and I'm going to get revved up. I fully understand that this stuff is kind of boring, all right? So please just bear with me a little bit. And some of this stuff I'm going to talk about is pretty mundane. It's stuff that, probably most of you know, but hey, maybe you need a little refresher. So in starting with your balance sheet and you're going down the list, you start with the cash accounts, right? So you have 3 or 4 cash accounts. You need to get those reconciled. I know it's pretty easy to say, but a lot of times when I'm looking at cash reconciliations, I'll see a lot of little, junk transactions that kind of litter, like the uncashed check from 1972. I don't think you still have an uncashed check from 1972, and I don't think you have a deposit in transit from 2005. All right, I've caught on to you guys. I don't think they exist. So what I'm asking for is, take a look at those, try to get those addressed, and one of the things that people have a tendency of doing is just deleting it. Oh, we don't need that check anymore. Unfortunately, that can throw off other things like retained earnings and, some other balances. And so what we're looking for is for you to not necessarily trick QuickBooks, but create like a credit memo or void out the check, but then apply that AP item to a credit memo or something like that, so you get rid of it in the current period, which is uber important, right? Because if you go in and start deleting these transactions, then it's going to throw off retained earnings. And then that makes my job a little bit harder, because then I have to figure out what you did, recreate it, and then address it. So one of the things, keep in the back of your mind, is that, yeah, you want to deliver better financial product to your CPA. But I also, in my head, I'm thinking I'm trying to be altruistic, because there's a value proposition in what we do and what you guys do. And I want to make sure that you guys use all your tools in your tool belt before you give it to us. And then we can concentrate on helping the business owner with their tax decisions. And I know you're like, okay, tax, that's so boring, and you don't deal anything with it. But ultimately, the way I view my role is, you know what, if I can save a client $1, I'm going to work my tail off to save a client $1. If I can save the client $5,000 off their tax bill because I have good financial information from the bookkeeper, I definitely want to save $5,000 for my client, all right? as you're kind of listening to me drone on, is that's kind of that's the value proposition that we add. We want to spend less time on making sure the balance is balanced, and more time on tax planning and trying to find those gem of an opportunities when we prepare the tax forms. So that's why I'm thinking that, we're all in this together. So moving on. So we have reconcile, monthly, and timely. Timely is key. You don't want to sit down 6 months from now, reconcile the entire of last year, because what's going to happen is that, someone could be stealing, and it takes you 6 months to find it. No one wants that. So I propose that you keep up on it with your clients, monthly, get to it right away, get those cash reconciliations done. Look for those stale data transactions, those deposits in transit that are hanging out there forever. Figure out how to get those reversed in the proper year so it doesn't throw off anything else. Okay, who knows what a sheet means? A sheet. Okay, has anyone ever sheeted? I know it sounds like a dirty word. All right. No, you've sheeted? Michelle is sheeted. You've sheeted, Michelle? In Florida. Florida, wow. So what a sheet means, it really isn't a dirty word. It sounds like it, though. I had a fun one, going through this yesterday. But a sheet means is that if you have a stale-dated payroll check, let's say, or a stale-dated vendor check, what's going to happen is after a certain statutorily, and they're all different per state, after a certain time frame, let's just say a year, you have to transfer custody of those funds over to the state. Because you know what? The state will do a better job of getting money into the pockets of who you paid, all right? So that's what a sheet means. There is, who's heard of the unclaimed property database that Arizona has? You can go on to, I don't know what it is, unclaimedproperty.com, Arizona, whatever. You can go onto that website, put in your name, and in the state of Missouri, I got like a $5 payroll check because I worked 1 hour doing something. I don't know. But I'm still listed, so the company sheeted money to the state of Missouri, and I am still listed to this day as having $5 outstanding. Okay, so I could go claim that, but I think it's more like a pride thing with me. I don't know why. I'm probably on many databases, but oh hey, all right, okay, I deserve that one. Okay, so that's what a sheet means, and so technically you're supposed to transfer custody of your assets over to the state, and it's going to be listed on the database. All right, and then that poor little soul that lost its check can get its money because the state does a fantastic job of notifying you, because they wouldn't want to keep on to that money and earn interest on that money. No, of course not. Okay, so one of the things is, and I harp on this a lot, especially with newer staff people, is that I'm a big proponent of doing a balance sheet with a comparison column. So right now we're in 2019. It's going to end soon. So I'm going to have 2019. I'm going to have 2018. All right, and I want to look a year-over-year comparison just to see if things make sense, right? So are there negative cash balances? If there are, why are they? That's kind of a big thing. One of the things too is that I've recently noticed that I have one nonprofit client, and it's kind of funny, not really to me because I'm a little bit paranoid about some things, but they just forgot to record their investment account, their Wells Fargo investment account, for 2 years. So I didn't know about it for 2 years. It wasn't a big balance, but it's those things that just, oh yeah, we got to open up a investment account so when we receive stocks, we got to clear out the stocks, sell the stocks, and then it just goes, we get the transfer into our main operating account. Well, they still, in this particular instance, they still had some money in that account at year end. It wasn't a lot, it was like 12 grand. I mean, to me, that's a lot. But it's one of those things where they just didn't even think that they needed to get it onto the balance sheet and get it reconciled. So what I harp on a lot is, making sure in your head you're doing these reasonableness checks, and you're forming expectations on what balances should be versus what they are. So that's very key in going down the balance sheet and understanding each number. All right, I'm moving on. Accounts receivable. Okay, so I have one client who I'll pick on a little bit, and they're not here. So, but I was doing some tax planning recently for this particular client, and I love them to death. I love working with them, but they recently went through a bookkeeper change. So the old bookkeeper, she would get on my case about not giving her pennies on my adjusting journal entries, and the new bookkeeper was like, what's an adjusting journal entry? So you have a little bit of a challenge and learning curve when you're kind of working with that outside bookkeeper, or not outside bookkeeper, but that client bookkeeper. And so we're going through the balance sheet, and it's becoming glaringly obvious that things, are a little out of whack. So I have her send me over a PDF of the accounts receivable. And in that accounts receivable, there are like 50 items. And it's a little bit of a volume-based business, but not that big of a volume-based business. And there was like little microtransactions, as I call them, like the -2 cents and the +7 cents, because someone just paid a little bit wrong. So there's about 20 of those. Then there was a lot of dollars in that AR report that were really customer deposits. So there were like big negative numbers. And so they really kind of shouldn't be on AR. They need to get maybe moved over to a liability account called customer deposits. As we're kind of talking through these, she kind of began, the light bulb started going off, saying, you know what, I need to look at this stuff. And so it was really cool to see when that light bulb went off. I was very happy because then she got it. And then I said, okay, you know what, let's stop there on this report. You know what you need to do. Get it back to me, and you know what? I'll be darned. There was like only 15 AR transactions on there. Every balance was legitimate. She had tied out everything. And so one of the things that I do as I'm working through client work is that I'm making sure I coach at the same time. So by having that 15-minute phone call with a client, she was able to go back, rework her entire AR schedule, work with the owner of the company to make sure that that balance is legitimate. And you're thinking, I already do that, and I appreciate that. But I know that there's several clients that I have that don't really do that extra step. So I just want to make sure that you kind of understand, hey, look at the subsidiary reports. Make sure that you have everything tied out before you hand it over. So that's one of those things. Okay, write off uncollectible balances. So that's another big thing. Write off uncollectible balances. So what does that mean for an accrual-based company? I know there's a couple nonprofit clients that are here, and then there's a lot of for-profit clients that are here. So why is it important to write off uncollectible balances from a tax perspective for an accrual-based business? Does anyone have an idea? Taxable income, right? So if you're not going to collect it, if you're an accrual-based business and you pay tax on what you bill, because remember the cash basis business is you pay tax on what you collect. So if you have less accrual-based income for an accrual taxed business, you're going to have less taxable income. So I don't know about you, but most of my clients like paying less tax than more tax. All right? That's just how they kind of come to me and say, hey, I'd rather pay less tax than more tax. That's what they say. That's like number one answer. Hey, Jed, I like to pay less tax than more tax. So that's what they tell me. So I try to make that happen as legally as possible. There's some clients that are like, oh my gosh, are you kidding me? Did you just think of that? But no. So that's what we're saying here is that for an accrual-based business, you got to get rid of that uncollectible AR. Go through it, meet with the owner, go through it, make sure that everything is legitimate. write off anything that is not legitimate, and then, and then you're done. So, okay, fixed assets. So this is one of the things. So about 4 or 5 years ago, the IRS kind of changed their approach on fixed assets. So there's this concept that that you're supposed to capitalize an asset, all right, that's going to be in use for longer than a year, or it's going to be, like I come up with it. So there's this threshold out now, and I love to use it. I know other CPAs don't necessarily use it, but it's $2,500. So and this is for a company that doesn't have a audited financial statement. So the threshold is $2,500. So if you buy one asset, like like a refrigerator or a computer monitor, that is under $2,500 each item, you can expense that. All right. If you buy an asset that is, if you have an audited financial statement, that's $3,500. You can now expense it because you adopt this what they call as a capitalization policy. So this capitalization policy, if you adopt it, it says, hey, anything under $2,500 I can expense. Anything, and if I have an audited statement, anything under $5,000 I can expense. And so that makes your lives a lot easier. All right. So I highly encourage you to work with your outside CPA in making sure that you've adopted whatever capitalization policy and adhere to whatever the capitalization policy says, because okay, so here's my best example. I used to work on this one client, big contractor in town. This guy was kind of antiquated. He would capitalize office chairs. So he would go to Office Max, $99 office chair, and he would get on our case if we didn't capitalize it. So I'm going in the back of my head, why capitalize a $100 asset? I don't even want to capitalize a $1,000 asset because more than likely we're going to expense it using 179 or bonus depreciation in the first year anyway. So it just creates a little bit more work for me. Well, the client pays our bills, so I'm going to do what the client says. But now I'm kind of in this position, and when I have clients asking me what I would do, and I just coach them. Hey, anything under $2,500, just go ahead and expense it, and then let's capitalize everything else, and then we'll calculate depreciation, and if we 179 it, I'll give you an AJE for the depreciation adjustment, and then we'll move on with life. So there's a lot of things in our tool belts that you guys might not know about or see regularly that we utilize. And so what I'm saying is that keep it easy on us, adhere to some type of policy, let us know what that policy is, because you can, as long as it's under $2,500, if you wanted $1,000 and you capitalize everything over $1,000, then do it. I know I know nonprofits, there's this one strategy that I've seen go on, is that they want to capitalize everything. They want their capitalization policy so low, like $500, because that makes their P&L look a lot better. So in for-profit companies, they want their taxable income as low as possible, versus nonprofits, they want their income higher, right? And so there's that strategy, and we kind of constantly battle what makes sense a lot of times. But so I definitely implore you, to look at your fixed assets. One of the other things that I love more information than not. So when I get a package from a bookkeeper or a client, I always need a little bit more detail. So one of those things that you can help us out with is give us the date, the description, and what you bought. Okay? So, you buy a new truck at the end of the year because you're managing your tax bill. Great. Just give us all those details. Trucks are in this curious case where we need a little bit more information, because some trucks qualify for good depreciation or best depreciation, and then lighter trucks or lightweight trucks like a Chevy Colorado, they don't qualify for some of the better depreciation. So we have to ask more stuff with trucks and SUVs. but give us as much information as possible. That makes our job a lot easier. And we can do better tax planning too, because usually clients are coming to us right about this time so we can get them some good ideas to save money on their tax bill and the like. So one of the things I've seen used a lot is combine. Every time you buy a new asset, you'll put it in a new asset account. I'm not a big fan of that. I don't like that. I don't like a 3-page balance sheet. I like stuff a little bit more concise. So try to stick to accounts that make sense, like all your vehicles in one account. You don't need a new account for each vehicle. Stuff like that. Leasehold improvements. Buildings, don't create new accounts for every building upgrade that you do. So just kind of keep things nice and tidy. On our end, if you ever need the detail, we got it for you. We have this great thing called depreciation schedule. We can saturate you with all the data that you want regarding that. So I'm a big fan of trying to keep it nice and neat. Clean up. Current liabilities and payables. So on AP, same with AR, you're going to have these micro balances. You're going to need to, just cleanse that. Make sure that everything is off. Tommy, what's up?
What constitutes a micro balance?
I don't. I use micro balance. It's like that 50-cent type stuff that you didn't pay all the bill, or maybe you have a little bit of credit on your account because you overpaid by $20. I don't know. Yeah, you want to keep track of those credits, but sometimes just stuff pops up, and you just kind of want to just get it cleaned up once and for all, and don't let it bleed into the next year. So it's those little junky things that show up from time to time. Payroll liabilities, usually that I see a lot of these little micro balances in payroll liability accounts. There'll be the 72 cents in the Social Security payable account, stuff like that. You just want to get rid of that because it's not adding any value in the overall scheme of things. I mean, when you're talking about maybe a business that sells widgets, gross sales is $1 million a year. You don't want it to be littered up with $5 worth of junk stuff. Make sure all AP is recorded. Again, this goes back to the accrual-based taxpayer concept, where accrual-based businesses can reduce their taxes by making sure that everything that all the little AP items get entered correctly, right? If you're dealing with a big tax bill, we got to make sure that you have proper cutoff, so that attorney that you used for something in November, but they bill you in January, more than likely you can accrue for that piece and get it into this fiscal year instead of next fiscal year when you actually get the bill. We look at that stuff, we ask that stuff. You guys are in the weeds when you're doing this stuff, so you want to grab that stuff as soon as possible, identify it, and get it into your AP or accrue separately for it. This is one thing I love working with newer bookkeepers on, is that let's work our tail off to make sure that all of the balances are verifiable. Usually you're getting statements from outside sources like loan companies or car loan companies or the like, or maybe you have like internal amortization reports that you generated because there's a previous shareholder that's getting bought out, something goofy like that. So you want to make sure that you have all of your year-end balances tied out to some third-party statement. And then, later on, you're going to get a copy of what we usually request out of our clients when they give us that package to prepare a tax return. I've kind of created like a 10 thing that you can just kind of, keep with. And so you're looking at, that's one of those items, is making sure that you give us the year-end loan statements. Credit cards are kind of tough, and I'll talk about that in a second, because credit cards, they never end. The statement cut date isn't never 12/31. It's always like 1/10 of the next month. So that's a battle that I'll talk about here in a second. But verify all balances. I bring up this utility company thing because they're notorious for, okay, you put down a deposit, and so you were smarter. We got it recorded as a deposit on the balance sheet, but you know, maybe in March, they went ahead and grabbed that deposit and put it against the electricity bill. And so we just got to make sure that that stuff gets tied out. So make sure all your, you know, leasehold deposits with your landlords and all that balance to the lease statements, that sort of stuff, or the lease agreements. Okay, so I thought of this idea last night, is sales tax, and I would love some feedback on how everyone is handling sales tax. So just to kind of give you a little background, about a year and a half ago, the Supreme Court had this Wayfair decision that just uncorked everything for sales tax. So I have, as clients, I have several internet-based retailers. So what used to be, we filed a sales tax report in the state of California for this particular client. Just one, and they also had presence in New York, right? The best states to operate in ever. They're awesome. No, not at all. So we have to file sales tax reports in each of those states, all right? And that was pre-Wayfair. Post-Wayfair, we have to look at where the sales are going, into what states they're going into. So we're trying to figure out what the, you know, we're trying to look at all the madness, because now I have to file a sales tax report in Kansas. I mean, they had 50 or 75 transactions in Kansas, but Kansas's threshold is so low that now I have to register with that state and file monthly sales tax reports in that state. And I'm like, there has to be a better way. So we've looked at several different software vendors out there, none of which I think really have their stuff together yet, because this is just difficult stuff to maneuver around. There was one concept that I thought was really clever, is that, for lack of a better term, there's like program states, where if you opt in, you have the software vendor registers with each of the state, and then you pay the software vendor, so you don't have to register in that state. So you kind of do an end around. So you just pay the software vendor the sales tax liability, and then they pay the state. And there's a whole lot of trust going on with the state. But I thought that was pretty clever. So I don't have to register in each individual state. That vendor does it for me. So there's 24, 25 states that are signed up for this process, and I think it's wonderful. Of course, all of the high tax sales tax states, the high volume states like California and New York, they don't want nothing to do with it, right? So and so I don't know if you can tell my frustration with sales tax, but it is unwieldy right now. So because there is no one perfect solution. So if anyone out there has a good solution, let me know about it, you know, after or whatever, because I'd love to talk to you, because it's just a menace. Okay, so credit cards need to be reconciled. So one of the biggest things in my list when I was developing this was, what I've seen a lot over the years is that when a client pays a credit card bill, that's awesome. They pay the bill. But what they forget to do is enter in all the expenses that get associated with that bill. So they'll what I've seen before a lot of times is that they'll cut a check, they'll code it against credit card liability, and then they have this big, huge $100,000 negative balance sitting out there. And so what they forgot to do is download all the expense transactions and code them out. Or they forgot to, you know, create an AJE or something, put an AJE in that moves stuff over to the P&L and records everything that way. So what I'm saying to you is that, okay, great, paying a bill is one thing, but we got to make sure that the credit card properly balances, all of the expenses get picked up on the P&L correctly, and, you know, if there's any fixed assets they purchased, you know, we got to get those moved over to the balance sheet for me to depreciate. Let's see, and there's two ways to do it. I prefer using in QuickBooks. Most of you guys are in QuickBooks. I'm sure there's a handful of you guys that aren't in QuickBooks, but I love it with using the credit card liability. Download the transaction, set up the banking link with or with the credit card link. Download all the transactions, pay online, do stuff online, because to me, it's safer. I don't like cutting checks anymore because mail fraud and all that stuff. I'm a big believer in paying stuff as much as I can online. But get that into your repertoire. I think you're going to be a lot more happier that you don't have to sit here and code out every transaction. So I highly encourage it. Let's see, pro tip. Okay, so pro tip, January is that wonderful month where usually the credit card statement cuts on the 15th of the month, and there's still December transactions. So a lot of times I'll make sure I go back and I'll ask the outside bookkeeper or the internal accountant, hey, did you grab those December transactions on the January bill? If so, give me a copy of the January statement. Let's reconcile that out, make sure we got everything. If there was, clients have a tendency of looking at their bank account at the end of the year and then spending every last dollar that they have. They'll charge a whole bunch of stuff. So I just want to make sure we get everything into the proper year. One of the things in for-profit companies is I see a lot of, not a lot, enough to mention it, is that entities taxed as partnerships, and that means LLCs are taxed as partnerships. Those owners of those companies don't get W-2s. That's a no-no. IRS has ruled on it. You got to move them over to guaranteed payments. Same concept. I mean, IRS is going to get their money through estimated payments, but you got to look at that. I saw one recently too, again, and I'm coaching them, hey, you can't do that. We got to move the owner over to a guaranteed payment. They just get a big fat check, and then of that check, if they're responsible, they're going to take some of that and pay it into the government every time they get that check. Or they can wait till they have to pay in their quarterly estimates. So I see that a lot. One thing I see that I would love to see more of is reconciling payroll to the W-3s and 941s. So there's these, payroll reports that get generated from your payroll provider, maybe Focus, that get sent to the IRS and all those wonderful little government agencies. The concept is that what gets reported to the IRS need to get reflected on what's actually happening on your P&L and what you're going to report on your income tax return. So that's a big thing for us. We want to make sure that's happening. Year-end payroll add-backs, S-corp owners. There's many different taxed entities out there. S-corps are one of them. I love S-corps. But there's special add-backs for 2% or greater owners. And so you're looking at adding back their health insurance and adding back some of the HSA stuff. For employees of those same companies, S-corps, partnerships, whatever, there's other add-backs for those guys. So you're going to add back, group term life insurance that's the dollar amount value over $50,000. There's some of that disability insurance, some, maybe some other perks that they're getting, personal use of vehicle. Leases. So leases is always a big question. Earlier this year, I had a cleanup client. And what I call a cleanup client is the guy that comes in that says, Jed, I got all my books reconciled. I'm ready for you to do my tax return. I'm like, great, let's do it. When'd you last file? 3 years ago. Okay. All right. And in those 3 years, I bought $7 million worth of equipment, 52, whatever, Caterpillar this and Caterpillar that. And so each one of those sales agreements or lease agreements is completely different. So he had no idea kind of what we needed out of them. And and Matthew helped me out with that one. And it was just a painful exercise. So what we had to do was we had to grab each lease agreement or sales contract, because he didn't have any of the loans recorded. Why would he? But everything, why would he? So he was just making payments, and because he needed to pay the bill. So he wasn't amortizing the loans. If it was an operating lease, he was doing a good job because he was just dumping it into lease expense. But for those capital leases, you have to go into those lease agreements, understand and try to decipher if it's an operating lease or a capital lease, and then set up, if it's a capital lease, you have to set it up like a real loan. capital leases are, there's going to be those hallmarks. The biggest one that everyone knows about is there's like those dollar buyout options. So at the end of the capital lease, you can pay $1 and then get the title. So you're going to be looking for that stuff, that language in the lease agreement. And then set it up as a traditional loan. So you're going to have to impute interest, and we can help you out with that. And when you make a payment for that capital lease, part of it's going to go to principal, the rest of it's going to go to interest expense. And so for this particular client, there was like 52 that we had to get recorded properly. It was that was a big bill. Sorry, but that was a big bill. So, operating leases are a lot easier. Those are the ones where, okay, you can buy it out, but it's going to be 20% of what the residual cost is going to be. So those are the operating leases. Get those expensed right away. Capital leases, treat it as a loan, so you're going to reduce principal. You're going to have an interest component. Let's see. Mortgage and loan accounts. So going back to that concept, hey, tie stuff out to a statement. Make sure your principal reductions have been entered correctly. When we're going through stuff, because what we love to do as CPAs, because we add, and this isn't really a joke, but sometimes I joke about it, is that we add tremendous amount of value because we make sure that stuff is tied out. I get a giggle sometimes when I get records from clients, and thinking of one in particular. So they've set up 7 different loan accounts for one loan. So they love just saying, because they have people in their books all the time, different people, and they don't really necessarily train them that well. So every time they make a payment, it goes to a new account. So if you could do me a favor and not do that, I would be very much appreciative. And then maybe go the extra step of, yeah, you got the 12 payments, but make sure that the principal balances it to the year-end statement, or if the statement gets cut on the last, in January, tie it back out. So perform, and I do this all the time. So this is that next level of value that I think I add. Perform a reasonableness test by looking at a year-over-year comparison. I love that stuff. I think, Matthew, Selena, how many times do I harp on giving me, when you're printing off financial statements, giving me a year-over-year comparison, right? Every single time. Year-over-year comparison, because then I can look at trends. I can see if stuff looks reasonable. I highly recommend you do the same thing. Moving right along. Okay, so retained earnings. So if there was a linchpin statement that I could give in this whole presentation, I think this is probably one of the most important things. And I think if you're building your business as an outside bookkeeper, one of the things that you could do for us poor CPAs is reconcile your retained earnings or close your capital accounts. Some of this stuff might sound foreign, but ultimately, I expect the retained earnings on the balance sheet to match the Schedule L on the tax return. So the tax return, and I like to use good CPAs versus bad CPAs because we're not all created equal. I think we're really good. That's another marketing plug. But I see a lot of work. I pick up a lot of work, and I always know when a CPA doesn't present the balance sheet on the tax return, there's probably something wrong going on. So I have to ask a lot of questions. I have to maybe back into beginning balance numbers. So as a firm procedure requirement, we have to present a balance sheet for 99.9% of our tax returns. That's just how we operate. And so on that balance sheet, which is like page 4 or 5, depending on the form, there's Schedule L, and there's a retained earnings number. That number, and this is for corporations, that number should be the same number on your balance sheet, right? So they should match. And so that's what I'm going for. And so those AJEs that you get from us at year end, you want to get those in there into the proper year. You want to close the capital accounts. So capital accounts are somewhat esoteric term. If you have a partnership taxed entity, you don't have retained earnings. Those retained earnings get distributed to the other partners or the other owners of the company. So taking that extra step to reconcile your retained earnings or close your capital accounts would be tremendous. We always give as a requirement when we produce work for a client, we always give a final trial balance and a listing of AJEs. So ask for that. We'll email them to you. You know, I think we do have, I know the courier pigeon's on its last leg, but we can courier pigeon it over, smoke signal it over. We would love to get that stuff into your hands so you can reconcile retained earnings. And then I'm going to blow your mind here. Set a closing password. Okay? So in QuickBooks, there's a way to set a closing password in QuickBooks. I know I'm blowing everyone's mind, but what happens if you don't set a closing password? If you post or delete a transaction, can throw your retained earnings out of balance. All right? So Selena can attest to it, Matthew can attest to it, Allison can attest to it. I like to set my closing password at $500. Okay? Why do I do that? Because that's what I'm going to charge, and this is what I tell clients, jokingly, kind of not, but jokingly. That's what I'm going to charge clients if they don't set a closing password, and I have to go back and re-reconcile the retained earnings. So $500. I love it. So highly recommend, once you reconcile your retained earnings, set that closing password on the previous year. If you're good and you have good cutoff processes and you're balancing everything on a monthly basis or quarterly basis, up that closing password to the first quarter because you have everything reconciled. I highly recommend it because sometimes stuff bleeds into the previous year and it just drives you nuts when that happens. Setting a closing password will prevent that. Okay, cash basis is usually way to go for tax because you pay tax when you collect the money. You on accrual basis, you pay tax when you bill for the money. And so we love it when we pay tax on collections because, you know, we get to manage the tax bill a little bit closer. So more and more CPAs, and this statement, give us accrual-based everything, okay? We, as a firm policy, and more CPAs are going to this, will present your balance sheet on accrual basis, but then adjust the book income or the accrual-based income to cash-basis income through the use of these concept called M1s. So give us accrual-based everything. Even if you maintain that you're on a cash-basis system, or just give us accrual based, and then we can do our conversions, and we'll be a lot happier. We always prefer to maintain your tax books on accrual base and do our conversions. Okay, business versus personal. I know no client ever has tried to sneak through a personal bill. I don't really need to talk about this. I've never seen it before. I never do a GL review and like, hey, you know, your subscription to the gym or your membership to the gym, you know, that's not really business related. That's more personal. I've never seen that. I've never had that conversation with the client. So I just need to move on because it's rarity that happens. Owner loan. So this is a big one. IRS loves to harp on this. Owner loan. So if the company loans money to the owner, all right, you got to document it. You got to put there's special, you know, threshold rules out there, but you got to put a promissory note in place with a imputed interest rate. AFR, which is the applicable federal rate, is pretty cheap right now. It's like 2 and change. But 5% is always a good standby. Amortize the loan. IRS loves to see stuff like that and the more stuff that a client does right in the eyes of the IRS, if they're ever challenged on something else, one of the arguments that I love using, and I'm a realist, is that, hey, IRS, they're doing so many things right. Come on, you got to give me something over here. All right? So I use that a lot. So the more stuff that you do right, if there's something questionable on the return because whatever stuff happens, then I can usually battle for you. But if you don't come to the table with anything but a mess of records that are a mess and all that stuff, it's tough. It's really tough in the front of an auditor to get by with anything. Yeah, get your CPA involved. I highly recommend that. Ask those questions. Should this be a loan, a distribution, all that stuff? Should I have a promissory note? get your CPA involved. There's a concept called S-corp basis. I'll skip that, but it's very important when you're deducting losses. Okay, final review of expenses, and I got to get going. Consolidate questionable transactions to like one account. Don't like sprinkle them through the whole P&L and expect me to go on a choose-your-own adventure trying to find, everything. I mean, I love you guys, but I don't love you guys that much. Stay away from using the miscellaneous account. One of the things that Tavi and I were going through, she brought up, is that, Jed, you know what? One of the things that you should bring up is for the outside bookkeepers out there that you're going to be speaking to, is that, you know what, there is a trusted advisor status that you guys enjoy, all right, that maybe we don't have yet. But be an advocate for your client. Ring that bell when something looks off. Well, obviously when the cash account is negative, but you know what, if he's heavy on employees because he just doesn't want to term anyone and he's running his business into the ground financially, you got to make some hard recommendations. And so I strongly implore you to help your clients manage your business or their business. Yeah, document request list, you're going to get that. It's really good stuff. If you don't use us as your CPA, or if you have other clients with other outside CPAs, use this. They're going to love you if you give them all of this stuff in one sitting, so we don't have to keep on going back and asking you more questions and more questions. Questions I'll always ask. Did you file your 1099s? It's we have to just check boxes on a form, and we got to make sure that things are happening the way they should be happening. And any address changes or any address changes, any ownership changes, any significant events like they sold a building or something like that. So there's a whole bunch of that. So last marketing piece, so I'm a big fat liar, last marketing piece. So we're really good at what we do. We do a lot of good stuff. Some of you have experienced that. Some of you haven't yet experienced that. But I just want to let you guys know that we have a really good team. We've been in business for a long time. We're going to be in business for another 70-plus years, especially with the up-and-coming ownership group. So I'm really excited, and I think we're always going to be small and local. We're not going to be multi-citied. You're not going to – one thing I hear a lot when I get a new client is, Jed, I was at the bigger firm. I'm like, oh, yeah, okay, I know that bigger firm you're talking about. And I just felt lost. Like my stuff wasn't getting – the attention wasn't there. And so, you know what? You're not going to feel that way at RNA. So I can guarantee you that. So we have really good people here. I'm out of here, guys. I appreciate your patience with me. So Mr. Greg Stutz from Focus HR is going to come up and talk to us about a handful of things. Like I said, Focus HR, one of the few locally owned payroll companies, expert advice.
Good morning. My name is Greg, and I'm from Focus HR. As far as our agenda today, it's going to be kind of all over the place, and we're really going to kind of want to touch on a couple things. We're going to talk about closing out 2019 payroll, what opening 2020 looks like, capitalizing on some of what Jed had touched on, and then we're going to go all over the map as far as some HR things that we ultimately see as advisors to our clients or to the businesses that we work for. Touching on state unemployment, workers' compensation. We're going to talk a little bit about Fair Labor Standards Act stuff because we see that done incorrectly all the time. PEO and ASO, a little bit of a crash course on what that service offering looks like and how you can treat it as far as accounting is concerned. And then Clint is going to talk about turnover within your organization because employees are your biggest expense within an organization, and the expense associated with turnover is insane. So keeping your fingertips on that and being aware of where you lie with that is important. So getting into the payroll side of things. So Jed touched on this a little bit, but really to kind of drive this point home. If you are more than a 2% S-Corp owner, there's some W-2 adjustments that need to be made. Most notably, the company-paid portion of things like medical insurance and dental insurance, HSAs, things like that, need to be reported as reportable income on your W-2 for federal and state withholding, not FICA taxes. So we're going to be building those back into boxes 1 and 16. Additionally, S-Corp owners aren't subject to Section 125 deduction. So It's not uncommon for us to kind of take on a client and be looking at old payroll reports and we find that an S-Corp owner has had pre-tax deductions or something. All of that needs to be undone at the end of the year to make certain that their W-2 is correct. So touching on that, as bookkeepers and things, as you are aware that your clients may be 2% or greater S-Corp owners, you need to be telling your payroll vendor to make that adjustment, particularly if you've been handling your payables yourself or the client's been handling the payables. Your payroll company isn't going to inherently know. You want to be doing this with plenty of time left in the year. We get lots of clients that call us in like September of the next year, and they're like, oh, we messed this up, we need to amend W-2s. We can do that, but it's unpleasant for everybody, and nobody likes to file those 941Xs and all of that nonsense. So please communicate to the payroll vendors or whatever that you're using that that is the case, and make certain that they understand what needs to be built back into that W-2. Additionally, this kind of segues into talk to your CPA. If you have ownership changes within your organization, please tell somebody. As outside vendors, we don't know what you're doing. If you gifted half your company to your children or whatever, we have no idea. So that needs to be communicated. And as bookkeepers, as office managers and things, obviously you've likely caught word of that. So make certain that it's communicated so that we can get it reported correctly on a W-2. The next, and kind of playing off of what Jed had talked about, talk to your CPA. They've obviously have a tax planning strategy that they've worked to establish with you, and many of those things carry over to what needs to be reported on a W-2. So for example, as an S-Corp owner, in the eyes of the IRS, you need to take what's deemed reasonable compensation, right? So the quick definition of that is if you had to pay somebody else to do what you were doing, what you would pay them, basically. So that being the case, it's not uncommon for owners to pay themselves nothing throughout the year and then call us on December 28th or whatever and be like, hey, I need to show $120,000 in reportable income or whatever, which is fine, we'll get it done. You need to talk to your CPA about what your strategy is on that. And as bookkeepers, obviously you play a pretty heavy hand in establishing what that is. So please talk to your CPA. Also, please talk to them early. I'm sure RNA is reaching out to clients in November and December because they're proactive. I mean, again, it's sort of hit or miss on the CPA front whether they are or aren't proactive. We get a ton of volume of calls on December 31st at 4 p.m. Because they want us to run something through, which, again, we're more accommodating than most because we're small and we're a local organization. But if you called ADP and told them that, they'd probably laugh you off the phone. So know that and plan a little bit. Additionally, if you're even a bigger procrastinator and you're trying to do this in January, know that your taxes are probably already late and there's penalties associated with that. So be a little bit ahead of the game on that. Additionally, your CPA likely has a strategy that might entail maxing out your retirement or, again, other things that can be done to reduce your reportable income. They likely have a game plan for that. Please talk to them. If you're our client, let us know what you want to do. If you have another payroll vendor, let them know what you want to do. It can all be done. We can make a W-2 look like whatever you want, so long as you tell us what it needs to look like. Another thing that we commonly see, and Jed touched on this a little as well, is third-party sick pay. So this gets a little tricky, and third-party sick pay specifically, kind of backing up on the definition, is if you maintain some kind of disability policy within your organization and you have an employee that loses time from work and is compensated by that disability policy, that's reportable income. Now, really getting into the weeds of insurance contracts and things, in all likelihood when you were signing up for the disability program, there's a box on the application that says, I will handle the reporting, or that company will handle the reporting. So the MetLifes of the world and things will potentially send W-2s to your employees or your client's employees for short-term and long-term disability events. But if you checked the I'll handle it box, then you need to be doing some work and figuring out how much money was paid to that employee, what the tax withholdings were, and you need to be manually plugging that into your payroll system so it's reported appropriately on your W-2s. Again, this is usually a thing with larger organizations, in that most two-person companies don't have short and long-term disability, but it is an important thing. And then the final thing that we kind of see commonly done incorrectly at the end of the year is group term life insurance and the fringe benefit associated with that. So in a nutshell, if an employer pays more than $50,000 and death benefit life insurance for an employee, it needs to be reported on a W-2 as reportable income. Now, it's not as simple a calculation as just the premium is reportable income. IRS Publication 15B, if you're up for some easy reading, will outline fringe benefits and specifically how much money needs to be built into the W-2. I mean, the simple equation is if you're older, you're more likely to die, so it's more money that needs to be added to the W-2. If you're younger, you're less likely to die, so it's less. Regardless, it's likely if you're partnered with a payroll vendor, and any payroll vendor, they have some kind of understanding of this. You just need to be telling them you're doing it, because all too often a client's insurance broker's like, let's sign up for this benefit, right? And you're paying the bill because it's 100% employer paid, and you're probably expensing it correctly, and that's all great, but you didn't tell your payroll vendor, and they didn't tax it appropriately on the W-2, so if you came under scrutiny of any kind, you'd be up a creek. Let's get into 2020. So there's a couple changes that I want to touch on for 2020. I mean, these are common changes that happen every year for the most part. Nonetheless, just making certain that we're all aware. Again, if you have a payroll vendor, in all likelihood, they're handling all these things in the background. There's not much to be done on the accounting side. But know that the wage base for Social Security is increasing this year as it has the last several. On the 401k front, both the deferral amount and the catch-up limit for those individuals over 50 is going up. So if you guys as bookkeepers or accountants or whatever have some strategy where we see owners all the time that they're maxing out their 401k, so you're basically taking the total annual amount and dividing it by 26 or 24 or whatever the pay periods are, know that you'll have to fiddle with that a little bit to get that to square out at the end of the year. Same thing with HSAs. Those amounts are going up a little bit as well. So I mentioned that there's a bunch of different types of people in this room: office managers, accountants, bookkeepers, CPAs, outsourced solutions. But I wanted to kind of take a step back a little bit and talk about HR in a grander scheme of things. So, and basically what I'm getting at here is, I mean, how many of us are just bookkeepers or just accountants? Or, I mean, likely the answer is not many of us. We end up wearing a ton of different hats for our clients. And Tucson kind of being the market that it is, we have a bunch of small clients that have 5 or 10 people, and they don't have internal HR staff, so they rely on their resources, you being one of them. We're well aware that you guys aren't HR professionals, but nonetheless, we wanted to give you some tidbits, particularly from the accounting side, that you can very easily see on various payroll reports and income statements and things that should potentially be flagged and ultimately result in some pretty hefty costs within an organization. So that you guys can be advisors and kind of bring a little bit more to the table other than doing journal entries. So first I want to talk about state unemployment. So state unemployment, as far as payroll is concerned, is the only variable tax. So as you very well may know, it's based upon claims experience. So if you have a lot of unemployment claims and the state has to pay them, you have a high tax. And if you have few or none, you have a low tax. The range goes from 0.04%, which is nearly nothing and amazing, to 11.8, which is like a dumpster fire. In Arizona, the agency that's responsible for tracking and calculating your state unemployment rate is the Department of Economic Security. Other states have similar institutions. Some of them are state-run. In Arizona, we operate on what's called a reserve ratio. Now, this might be a ton of nonsense, but I think it's important to understand because controlling your state unemployment rate is paramount and tied to understanding how it's calculated. So we're not going to get too much into the weeds here, but we're going to go a quickly high overview of how that is basically calculated. So if you're a new employer in the state of Arizona, your unemployment rate starts at 2. Again, it goes up and down from there. The amount of taxes that you paid in has claims subtracted from that, and that creates a surplus. And then that's divided by your average payroll over the last 3 years to give a reserve ratio. So a reserve ratio is nonsensical. It's just a number. It doesn't mean anything. But it ties to this grid that DES has that ultimately ties to your unemployment rate. So if you're between a 9 or a 10, which again means absolutely nothing, but keeps probably dozens of people employed at the state level, you have a rate attached to it. So that's kind of how it breaks down. If you're on the negative side of things, again, you go way, way up, and it can be exceedingly painful. So what does this mean, and what are our takeaways as advisors? Basically, when you pay unemployment claims, it ultimately costs you money. Not directly. I mean, there seems to be a misnomer, even among our clients. They're like, oh, I don't want to lay them off because I'm going to have to pay unemployment. And they think that they have to, like, cut a check to the employee directly. That's not the way it works. The state pays them, but you end up paying the state back in the long run with a higher tax rate. So, again, the simple way to avoid that and keep your tax rate low is not have unemployment claims. Now, there's a saying in our industry that we commonly use, your employees can be your biggest asset or your biggest liability. So everything that we're going to talk about today really works, and particularly Clint's going to harp on this, to keep them in the former category. But inevitably, you're going to have people that you lose for whatever reason, either voluntary terminations or involuntary terminations. So put yourself and advise your clients to put yourselves in a situation where you have a winning hand. So I have a couple things that I wanted to touch on here. We'll dive in a little bit deeper. Collect letters of resignation. I mean, this seems pretty simple. If Bob walks up and he's like, I'm out of here, that's a voluntary termination. And the good news is he's not eligible for unemployment. However, there's nothing that stops Bob from going to DES 6 months down the road and applying for unemployment. And in all likelihood, you can probably say, yeah, he quit and maybe you'll win. But if you don't have a letter of resignation where you can prove that he actually quit and it's your word against his and he's claiming that, oh, I didn't quit, I was fired, you're in a tight spot. So again, just a little piece. I mean, be advising your clients or the companies that you work for, get a letter of resignation every time. I mean, it doesn't need to be super formal. I mean, if you're blue collar and you have minimum wage employees, I mean, scribble something on a notepad or something and sign it. That works, but get something. And then the next area is kind of the involuntary terminations and talking a little bit about that. So the biggest takeaway I can give any organization is document poor performance. I mean, this obviously has some benefit in some kind of lowbrow legal HR things being state unemployment, but I mean, if you have serious legal liability attached to some kind of wrongful termination or something like that, you need to be able to produce documentation that this employee was performing poorly. I mean, that's the mantra of the HR industry is document, 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 just like the realtors out there or whatever. So that being the case, I mean, be coaching your clients to do these things. To kind of give that some perspective, I mean, if you have a mass layoff and you get rid of 15 people, I mean, those people are actually eligible for unemployment. That's what unemployment is for. There's no point in fighting those claims. I mean, if you laid them off, they're eligible. However, if Bob walked out the door with the cash register, it's probably not eligible for unemployment. That one's obviously relatively cut and dry, and you likely just document the situation. But if you're working to make a case for gross negligence or negligence in general within the organization, ultimately leading up to the root cause of termination, you need to document that. I mean, unfortunately, just being generally incompetent isn't in and of itself an unemployment winner. However, if the employee shows up to work late and is, again, bordering on grossly negligent, then you do have a winner. So be documenting these things, because to walk through kind of the process of fighting unemployment claims so we can all understand, you get a love letter in the mail that says, Bob applied for unemployment. You either check the box that says, give him unemployment, or I want to protest this. There's some paperwork process that plays out thereafter. Ultimately, it'll escalate to the level of a hearing where you're talking to a judge on the phone, and you need to produce evidence. It's a little court thing. So please, 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 if you want to win these things or win anything in the HR world, be documenting this poor performance. The last thing you want to do is be like, yeah, you worked for us for 6 months, but I didn't write anything down, and he probably was a bad employee. I don't remember. It was 3 months ago. That doesn't play so well, as you'd imagine. And the final thing that I kind of want to touch on this point is try to be diligent concerning the managing of employees, but don't let them hold you hostage. If you have a 200-person organization and you have one unemployment claim, it's hardly going to sink you to 11.8. I mean, it's a drop in the bucket in a lot of regards. We talk to employers all the time that are like, oh, well, this employee's awful, and I would have gotten rid of him, but I don't want to pay unemployment. Well, don't put yourself in that position either. I mean, we need to find the middle ground here, because ultimately, a bad employee is doing more harm than good, and the nominal amount that your unemployment rate will increase is certainly not worth hanging on to this person indefinitely. Questions there? All right. The next thing I want to talk about is workers' compensation. We're not going to get into the nitty-gritty of workers' compensation. I mean, to give a 20-second overview for those of you that are not aware, workers' compensation is insurance that a business needs to carry to protect its employees should they become injured at work. This provides remedy for both the medical expenses as well as any lost time that the employee may have. As far as the calculations are concerned and how premium payments work, I mean, the simple, quick Cliff Notes rundown is if you're in a low-risk industry, it's inexpensive. If you're a roofer in a high-risk industry, it's expensive. There's a lot of factors that go into calculating an unemployment rate, and an EMOD is one of them. So an EMOD is an experience modifier for those of you that might not be aware. So our idea here and what we're really trying to bang home with the state unemployment thing, also with the workers' compensation is, I mean, as you guys are looking at income statements or whatever, and you're seeing the workers' compensation expense, or you notice that the insurance expense is way out of whack and trending the wrong direction, and you dive in and you see it's because of the workers' compensation. I mean, what we're really getting at is, as advisors, you should likely say something and speak up. They're likely managing the risk incorrectly. There's a lot of employers out there, and we bump into them all the time. They're like, well, that's why I have the insurance. It's to pay when people get hurt, which is true. But you don't want to turn a blind eye to it because it'll ultimately kill you as far as cost is concerned, specifically pertaining to your experience modifier. So simply put, when a company starts out or goes into business, they start with an experience modifier, an EMOD of 1. If they have more claims, both frequency and severity, than their peer group, it goes up. If they have less claims, it goes down. So if you have an EMOD of 1.1, you are paying 10% more in insurance premium than the guy down the street. So if you're talking about a bunch of clerical people in 8810, which is the clerical code, it's probably not that big of a deal and doesn't matter. But if you're a roofer and your workers' compensation rate is 20%, I mean, 10% is $2 or 2% of your total cost. That's huge. I mean, we've seen some clients actually like just have this thing go off the rails, and they're in a situation where they're paying, I actually have a roofer example to use, they're paying 60 cents on the dollar to their competitors 20 cents on the dollar. I mean, it'll put you out of business. You can't be competitive when your costs are 40% higher than your competition. So that's kind of how that calculation breaks down. It's important to understand how it's calculated. EMOD isn't tracked by the insurance company. It's either tracked by the state or a private entity or rating bureau called NCCI in Arizona. Same one in about 37 other states that's kind of managing this. It's the National Council on Compensation Insurance. So they're a third party. Your insurer is responsible for reporting all premiums to them, as well as whatever the claims company that's ultimately underlying the workers' compensation policy is responsible for reporting all claims data. The calculation is more complex than state unemployment, but basically it's money in minus money out, and that's where you sit in the world. So one thing to touch on is not every business is even large enough to have an EMOD. You need to have at least $3,000 to $7,000 in annual premium on your workers' compensation policy to be assigned an experience modifier. I don't know the bureaucracy behind it, but it's something like they start with the biggest ones and work their way down until they can't go any further. So again, if you have some clerical employees and your premium is $1,000 a year, your EMOD is just 1. But if you are a contractor of sorts and are paying in excess of that, you do have an experience modifier. So we're going to talk a little bit about controlling the cost and how you as advisors can kind of weigh in here. And again, paramount to all of this is understanding how losses are calculated. If you have an employee that is injured at work and receives medical treatment but has no lost time, meaning they're not compensating the employee for the wages that they missed by being out of work, only 30% of the medical amount is actually charged against the claim. That's a big deal because, again, the amount of money that's charged against your policy and reported to the state bureau is what derives your EMOD. So some of the strategies that we're going to talk about in a minute, like return to work programs and things like that, all tie back to the concept that it's less expensive and less detrimental to get somebody back to work quickly. And then the second thing to know is there's a cap on this as far as how much a claim can hurt you. Once you've eclipsed $17,500 in Arizona, and most states for that matter, that's kind of as bad as it gets. So these are the measures, and this should be your takeaway from workers' compensation on how you can advise your clients on how to deal with these things. So the first one is probably the most important. It's direct care. So we see all of the time somebody gets some trivial laceration on their hand or whatever and needs a stitch or two, and they go to the emergency room. Well, shocker, emergency rooms are expensive. And ultimately, your insurance company has to pay that, and ultimately you'll be paying that in an inflated EMOD over time. As an employer, you have every ability to direct care. So if you have somebody with a laceration, send them to urgent care or Concentra or whatever place is ultimately cheap to handle the situation and in the most cost-effective manner possible. In organizations that are more high risk, we certainly propose having some kind of direct care plan, particularly if you're open 24 hours a day. As managers, you can't be there all the time. So your middle managers or whoever's kind of manning the house at night or whatever needs to know what to do as well, because they too will try to send them to the emergency room. Do yourself a favor and jot down some instructions for your employees to follow as far as directing care. Again, don't be confused and use common sense here. I mean, if your arm's chopped off, please do something about it. Don't send them to Concentra. They're probably ill-equipped to handle it. The next thing I want to talk about is a return to work program. So on the last slide, we talked about how if it's a medical only claim, only 30% is charged against you. So to that end, it pays to get employees back to work quickly. Additionally, there's this misnomer with employees that workers' compensation can be used as like a free week off from work if they sprain their back or something. So work to dispel that within your organization. You absolutely can have a return to work program that it constitutes light duty. So if you have somebody that's a framer, for example, if you make them do some trivial filing task instead of letting them sit at home and watch Oprah or whatever the 2019 Oprah equivalent is, they're going to get back to work faster. It turns out they don't want to do that, and they'll make a miracle recovery and be back on the job in no time. So encourage your employees to do something like that, understanding the cost that it ultimately brings to them. The next is address employee frequency issues. If you're in a high-risk industry, obviously having safety trainings and things is important. There's a lot of conjecture in the HR world as to what's too much. Again, obviously, if you're talking to them every day, there's an argument to be made that it's kind of on the forefront of their brains and they're more apt to get hurt kind of on the fraud side of things. Regardless, it should certainly be addressed in high-risk industries. And pay attention to what's happening. If you have 7 people that get hurt from the exact same thing within your organization or your client's organizations, somebody needs to do something, like have a lifting class or, again, any number of risk management things tied to workers' compensation. As bookkeepers or office managers or whatever our audience is, I mean, we don't necessarily expect you to go out and give risk management seminars, but there's lots of agencies out there, including Focus, that can do those things. I think that your obligation as consultants to your client is to just say something like, something's wrong here, let's work to fix it. And then finally, I mean, we talked on maintaining a safe workplace. Safety trainings is some of them. Make certain that you have safety equipment for your employees, and safety programs. Some of them are a little bit more sizzle than steak, like don't get hurt for 100 days and we'll give you a t-shirt, which I'm not a huge fan of, but I mean, whatever works. So I want to pivot away from that a little bit and talk about something that we see all the time, and it's probably the mismanagement of FLSA, or the Fair Labor Standards Act, and wage and hour laws. For the most part, the things that are on here are kind of the changes that are coming. These are relatively lowbrow and relatively easy to adhere to. So obviously there's 20 states that are going to be increasing minimum wage in 2020. We're not going to list them all, but Arizona is probably, hopefully we all know that it's going from 11 to 12, so make sure that that's happening. Also, there's been a storied history about the FLSA and the salary threshold. So if you remember in 2017 or whatever, they basically doubled or tripled it. And then we were all running around trying to tell our clients that they needed to increase the salary threshold. And then that Texas court put an injunction on it, and then we didn't do that. And we've just been treading water at the $455 a week for the last 2 or 3 years. So this change allegedly is actually coming, barring any kind of injunction. So know that the salary threshold is increasing from $455 a week to $684 a week, meaning you can't have a salary exempt employee that isn't making at least that much. So again, kind of sticking with this concept, in the HR world, I kind of like to joke with people. When we go into a new client or whatever, I mean, really what we do is we start at the top in doing an HR analysis and kind of work our way down. And how we create this list is basically, what government agency am I most afraid of? I mean, when we're talking to HR consultants in California and stuff, I mean, the running joke is you can't comply with everything. It's literally impossible. You start with the easy things, you work your way down the list. I mean, there's like an obscure law in California that like, if you're a mechanic and you have you're supplied your own tools, you have to be paid differently than a mechanic that's not supplied their own tools. Like, nobody expects anybody to actually know this off the top of their head. Maybe the mechanics in the world do, but whatever. Regardless, I want to talk a little bit about my favorite one being the Department of Labor. That's probably the federal agency that I'm most afraid of, simply because, I mean, the IRS is a little bit annoying, but they'll come in and they'll do an audit and they'll be like, oh, you messed this up, fix it, you have to pay the taxes, and maybe 15% or whatever. The Department of Labor comes in with their guerrilla math, and they're like, oh, you didn't pay these employees properly, that's $20,000, and then we're going to multiply it by 3 because why not? And that's literally the way it goes. So we encourage people to do this correctly. And most notably, these are probably the 2 areas that we see smaller organizations doing things incorrectly. So the first is exempt versus non-exempt classifications. As business owners or business advisors or whatever, being cognizant of cost, it would be pleasant to just make everybody work 80 hours a week and call them exempt and pay them a flat amount. That's not legal, as we all know, under FLSA. And they have some pretty strict requirements as to who can be exempt versus who can't be exempt. The first is the salary basis test. Basically, if an employee shows up on Monday and does anything, like fogs a mirror, they need to be compensated for that day. You do have some liberty in withholding pay if an employee is out an entire day. But for the most part, again, if they show up for 2 seconds and then they're ill and they don't have any sick time or something, you need to compensate them. One thing that is not commonly known is if that employee shows up for 15 minutes or something, in the HR world, you have every ability to reduce their PTO balance to what their normal schedule would have been. So in that case, say 7 hours and 45 minutes. I mean, you can absolutely reduce their PTO balance, but you still need to compensate them for the whole day. They just need to be made whole at the end of the exercise. On the flip side, obviously that's kind of the negative to it, but you also, if the employee works 15 hours, then you don't need to compensate them more. They are an exempt employee. We talked about the salary threshold a second ago too. So to be considered an exempt employee, you need to pay them a certain amount. And then the final one is the duties test. So to be an exempt employee, you need to meet all 3 of these. And the duties test is the most kind of obscure. There's some professional exemptions and some sales exemptions that are relatively obvious. I mean, if you're a CPA, for the most part, you're just exempt. They're not really going to get into the nuts and the bolts of dissecting the position. If you're a sales employee, there's a lot of liberty granted under the FLSA that affords you the ability to be exempt under that. But the biggest one is the executive exemption. So we see people all the time, they're like, well, we want to make Mario exempt, so we're just going to say he's the manager of boxes. That's not a thing. You can't give somebody the title of manager by title only. They need to make material business decisions within the organization, and that's the definition that they're ultimately going to use. So usually, they would say that means that they have the authority to hire and fire individuals. They have certain people reporting to them, things along those lines. Again, this management exemption is a little bit of a gray area, but the box manager probably doesn't qualify. So the liability that this ultimately leaves us, tying this with a nice little bow, is if you screw up and pay somebody non-exempt, or sorry, pay somebody exempt and they're truly a non-exempt employee, the Department of Labor will come in, and they'll usually only come in when you have an employee complaining or something. They will audit all of your positions, ask for job descriptions and things like that, make their own determination as to who's exempt versus who's non-exempt. And then any employees that were classified as exempt but should have been non-exempt, you'll have to pay overtime back wages for them. Plus, they'll conveniently get everybody else that you misclassified. And again, then their guerrilla math calculation. So it behooves you to get this right on the front end. If you've been doing it wrong, or if you have a suspicion that your client's doing it wrong, say something. I mean, there's an argument to be made that as bookkeepers and accountants, you probably have some liability to advise them on best practices. The other thing that we would need to touch on is an employee versus a contractor. So this too happens probably more than I'd care to admit, but we have somebody that wanders into our office and they're like, yeah, I have this great idea. I'm going to save all this money. I'm going to take my employees and I'm going to put them on a 1099 basis, and then I'm not going to have to pay taxes. Well, it turns out the IRS is way ahead of you, and they have a 20-tier test that they kind of outline that determines whether somebody is a contractor or an employee. So we're not going to go through the whole 20-factor test, but for the most part, the questions that they ultimately ask when you face scrutiny on this is who sets the schedule. If you're requiring somebody to show up from 8 to 5, they're probably an employee. If you're presenting things on more of a project basis and they can do it whenever they want, you're starting to get closer to being a contractor. Does the individual provide their own equipment? I mean, if they're showing up to your office and using your computer and your everything, probably an employee. If it's their stuff, probably not. So a couple other things on that list. Do they have other clients? If they're exclusively working for you, probably more employee. If they have a bunch of other people, maybe employee or contractor. Contractors should be invoicing their clients. And the other one that they commonly ask is, can others perform the duty? So if you're like a house cleaner, for example, and you have 7 employees and you can send anybody to do it, you're a contractor. If it has to be you because there's some specialty and you're doing all of those other things, maybe you're an employee. So that's it kind of on the compliance thing. Again, I wanted to harp on some things that we can all see on various financial statements and make commentary to our clients too, again, to be advisors to them. Those are the ones that kind of pop to mind in our world that can really be harped on and I think could truly be controlled with an organization. I mean, business owners go into business to do whatever it is that they do, like be a plumber or a roofer or whatever. Not necessarily to harp on these trivial administrative things. That's where they rely on outsourced HR solutions like us, or accountants, or again, anything in their tool belt to kind of help them navigate those waters. But those are the things that I wanted to touch on quickly. That is that. So for our next piece, I want to talk a little bit about PEOs. So Jed ran us through the Focus HR commercial. I'll spare you that, but we're not the only PEO out there. And it's worth noting we're not exclusively a PEO, but PEO is a thing that exists, and it's more uncommon in Arizona than it is in some other states like Texas and Florida. But it is something that pops up from time to time, and as accountants and office staff and things like that, I want to make certain that you guys kind of have in your toolkit an understanding of how to account for it from an accounting standpoint. So quickly, Focus HR and what we are, we're an HR outsourcing organization. These days we do it in 2 different fashions. Some of our clients are aggregated under our federal tax ID number and the PEO, and others are aggregated under the client federal tax ID number or their own federal tax ID number. We call that ASO. So a PEO specifically provides various contracted services for their clients. Most notably, it's a human resources outsourcing solution. So historically, that's meant that if you weren't large enough to justify having an internal HR person, you would contract with a company like ours. These days, there's kind of a lot of hybrids. I mean, we have a lot of clients that are in the hundreds, pushing 1,000 worksite employees that have their own internal HR or staff or whatever, but partner with us to kind of supplement some more of the administrative matters. That's kind of the rundown of the role that we fill. Again, I won't bore you too much, but for the most part, it's human resources. We process payroll. We generally procure workers' compensation, not because we want to be a property and casualty insurance broker, but being based on a percentage of payroll and that risk management piece that we just talked about. It was always kind of the logical marriage there. Various retirement solutions, and then managing employee benefit plans. So most notably, obviously, the Affordable Care Act was a pretty notable piece of legislation and required larger businesses to offer medical insurance and blah, blah, blah. Those are the things that ultimately we work to manage. So again, tying up the concept of a PEO. So basically, we take all of our clients' wages and aggregate them onto our, under our federal tax ID number for tax reporting purposes. So as you can imagine, that makes our accounting life easier in that we get to file like one 941 a quarter for hundreds of clients. The IRS likes us because they get to reconcile one 941. Similarly, some of the things that Jed touched on doesn't necessarily apply. So if you're partnered with a PEO, you can't tie out a 941. You'd be looking at millions of dollars of all of our clients' wages. You just can't. So we have payroll reports, obviously, that very much mirror that. Same thing with a W-3. We can produce a report that looks like a W-3, but we didn't actually file a W-3 for your entity in and of itself because it's aggregated with everybody else, and it's hundreds and hundreds of employees listed on that W-3. So that is an important distinction to make. We get a ton of calls from accountants at the end of the year asking for those things, and again, we can provide reports that are essentially the equivalent, but understand that technically a W-3 doesn't exist. So the simple reason is, why do we do this? I touched on it a little bit. Efficiencies is probably the biggest reason. Additionally, I mean, when it comes to things like procurement of workers' compensation and benefits, when you put everybody under one federal tax ID number, you have a giant group. And in the case of workers' compensation, for example, millions of dollars in premium to leverage cost-effective solutions for your clients. So that's really the approach in partnering with a PEO. I want to talk about the accounting side briefly. So we have PEO clients, and we see it all the time, that are like tracking all of their taxes, like the FICA taxes and FUTA and SUTA and all those things on their financials. You can if you want to, but understand that you don't have to. In the eyes of the state of Arizona and most states and the IRS, once you've compensated the PEO, it's officially their problem. So if you guys ever face the scrutiny of an audit, you can say, hey, I have no employees. Now, all this presupposes that you're actually reporting all of the employees to the PEO. We have lots of people that try to pay people under the table. Don't do that. But assuming that all of your employees are paid through the PEO, you have no obligation to track tax liability. It's literally the PEO's problem. So for that reason, I mean, you're welcome to make your lives as difficult as you want, but your only true obligation is to track a cost of labor, which pretty much can be our invoice, which is simply gross wages, your taxes, likely your workers' compensation premium and benefit expenses, and our management fee. Just, again, book it as a cost of labor, reduce your cash, call it a day. On the flip side, for those of our clients that are, I already talked about that. For those of our clients that are on the ASO side of things, you could do that, but you also have some skin in the game here. So whether you're partnered with us or you're partnered with any payroll vendor, we find people all the time where we've taken on a client, we're like, hey, we need some quarterly reports from last year, and they're like, we don't have those. Well, you should have them, because if the IRS shows up and wants to audit you, it's your obligation to produce them. Saying, oh, I partnered with this payroll vendor or whatever isn't an acceptable excuse. It's your federal tax ID number and your responsibility to be able to produce those things. Now, when you call them, I mean, hopefully they've kept those things. They'll charge you an arm and a leg to go hit a print button, but that's the cost you pay by not having them proactively on the front end. But understand the difference. If it's under your own federal tax ID number, it is your organization on the hook. There's probably some wisdom, and I'll defer to the CPAs who are better accountant minds than me. Because of the liability that exists in classifying an employee non-exempt versus exempt, understand that there's some wisdom in tracking hours for even exempt employees. So this scenario that we run through and that we are ultimately afraid of is you have an employee that you paid as exempt. The Department of Labor says they're non-exempt. That employee says, I've been working 70 hours a week. They may have very well been working 40 hours a week, but the burden to disprove that claim is on the employer. So if you can't produce time records or something, they very well may just take the employee's word for it. Now, I mean, you can get creative and like run a swipe log or whatever as they're coming in the front door or something, but there's some wisdom in requiring even exempt employees to clock in and out for fear that they could claim that they were compensated incorrectly and fudge up their hours. Again, this really only comes into the fray in these gray area things. I mean, I'll tell you at Focus HR, we require all of our exempt employees to clock in and out. Not necessarily because we want to micromanage them. That's one of the reasons. But the other one is it's just a management tool. I mean, if you have somebody that's working 60 hours a week, you probably need to hire somebody to help them. If you have somebody that's working 30 hours a week, maybe you don't need them. Those kinds of things, and it helps you kind of keep your fingertips on those. But it also has some back-end benefits should you fall under scrutiny. But anyways, to bring your question full bore, if you have an exempt employee, you are compensating them on a weekly basis. You have no obligation to pay overtime. The other thing, while we're kind of on that tangent, that there's a couple things I want to clean up. Number one, and this is on a slide and I probably ran through it pretty quickly, make certain that you're telling your payroll vendor what your state unemployment rate is. It seems to be a pretty prevalent problem these days when we're taking on clients and we're collecting their UC-18, which is the state unemployment tax form. We see a rate on there from like a prior year. Understand that most payroll vendors won't proactively go get your new state unemployment rate, which again is changing on an annual basis. You'll get a little letter in the mail from DES that has your 2020 rate. You need to give it to your payroll vendor or they'll continue to withhold and pay based upon the old rate that they had. Now, in the state of Arizona, assuming that your rate went down, you're not going to get any kind of warning notice or whatever from DES. They're just going to quietly take the overpayment every quarter. And we've literally onboarded clients that had like $10,000 balances in there because their old vendor was over withholding. And like I said, frequency-wise, I mean, we're seeing this like 50% of the time. I mean, people just don't seem to understand that they need to tell their payroll vendor what their unemployment rate is. So as bookkeepers, there's always this grid out there. Every year the state comes out with this. If you're looking at a return and it's not one of these rates, it's not a 2019 rate. Every single time it'll be one of these 25 rates. That's the easiest way to kind of identify those problems. So yeah, please tell people.
So do you have any advice for that? I know they mail that form out. Sometimes they're in the wrong hands. If you don't have it, what's the best way to try to prevent it?
You can call the state. They're actually relatively helpful at telling it to you. In fact, they'll usually do it over the phone. The last time, we called them last week and they mentioned that they were going to stop doing it over the phone and you needed to submit your request in writing. I don't know if that is or isn't going to happen, but the other thing is, I mean, we're a little bit different than normal payroll organizations. So like, if you happen to be one of our clients, we actually go and get it for you. There are a couple exceptions. There's some states out there that, regardless of the fact that we carry power of attorney, will refuse to give it to us because we're not the client. Arizona's not one of them, so we're good there. But yeah, just. It does. Yeah, so if you're paying your own payroll taxes, you can see it through your portal. And that's actually how we see the discrepancies usually when we're onboarding clients, is because we're in there and we see a balance. But if you are engaged with a payroll vendor, you've probably never logged into your Arizona DES account. Yeah. So I managed to eat through all of my time, unless anybody has any questions. I will hand it over to Clint. So Clint Perry has kind of a storied history as a business advisor. He was an action coach in Tucson for a number of years. And then he worked for a firm called Lappin International, where he was an advisor to management within Fortune 500 companies. What he's going to talk a little bit about is basically the cost of turnover. So again, kind of thinking outside of the box from the HR standpoint, you guys get a front row seat to your client's turnover within their organization. There's obviously standards, and they're relatively industry specific regarding turnover. I mean, if you're running a restaurant, 50% turnover probably isn't unheard of or out of the ordinary. But if you're running an accounting firm, 50% turnover is freaking awful. So that being the case, understanding what that looks like and being able to speak up to your clients and say, hey, you have a problem here, and I don't think you understand how much you're bleeding money is important. So Clint's going to talk a little bit about that, some of our HR approach, and how we deal with that and advise clients so that you can kind of play off of that and work to save everybody a little bit of money, which is the name of the game here. So I will turn it over to Clint. Thank you.
Hey, everybody. So I'm Clint Perry, as Greg just talked about. And I actually have I think we have some reason to celebrate, some good news. So the first piece of good news is that I'm actually seeing the natural color on your faces all return to the natural normal state, back from your deep cryogenic freeze. So thank you for bearing with us. And I think the second part of the good news is, the reason to celebrate is I'm the shortest presentation on the agenda. So everybody raise your hand, happy, happy, happy. Okay. I'm going to talk to you today, share some thoughts about a topic that is, given my background in business coaching, and executive coaching, and HR consulting, is kind of a passion of mine, and something that's definitely a big issue out there. And how many of you, just by raise of hands, how many of you actually are in accounting professionals, bookkeeping professionals, dealing with you're external to an organization? You have your own clients, you have your own business. Okay, several of you. Rest of you, imagine, then work in a capacity working for an organization or a business. Right. So let me ask you a question then, real quick. How many of you, when you hear the business owner, the CEO, the executive moaning, groaning about their, what keeps them up at night, and what do you hear? What's the complaints that you typically hear? Call them out loud. Person just quit. Okay, what else do you hear? Late every day. What else are you hearing? What are they just complaining about? Wish they could change. Whole cost of paying payroll. Okay. So, I tell you that, the biggest, I talk to dozens of business owners every month. And we have 300-ish clients, business owners here in Southern Arizona. I think we're aggregated up around 6,000 worksite employees. Number one issue, pervasive. How do I find and keep good people? Can't find good people. They just don't exist. Okay, that's all I hear, at least. That's number one on the issue. So, listen, we're going to talk about that today, and we're also going to talk about my purpose today. Ultimately, would be there's two sides of the coin. First of all, there's how do you get good people, which I'm not going to focus on today because we could take a whole other presentation to talk about that. The second thing I am going to focus on, though, is how do you keep people, and how do you reduce your cost of turnover? Because, ultimately, if you want to solve your hiring conundrum, fix your retention rate. And you all are on the front lines. As I'm just going to piggyback on what Greg said, my experience in the last 15 years in working with bookkeeping and accounting professionals is that you all are trusted advisors, in many cases confidants. And I'll add a couple of other titles to the list that Greg talked about. Therapist, referee, coach, okay? It's amazing some of the roles you end up, just by virtue of what you do, getting involved with. And so business owners and such will look to you as important people they can talk to. In many cases, if you're running processing payroll, somehow, some way you become their de facto HR manager. You ever had that experience? They're asking you HR questions. Ultimately, what I'd like to do today, my purpose, though, is to help, first of all, have a real conversation about this, why it matters, why it should matter to you, and why it certainly matters to your employers and or your clients and their bottom line, because it is a big, massive issue out there, and what you can do about it. Okay, so let's jump into this a little bit. What's driving this issue of employee turnover and whole issue around talent, finding and keeping good people? Well, number one, record low unemployment. And number two, we're the knowledge economy. Okay, used to be in the day where you could differentiate yourself by your product or your service. Guess what? Today, the way you differentiate your business is by talent. Your talent and your leadership caliber that you have in your business. That is the true differentiator. And so as we think about this and what's driving this, ultimately, let's think about, well, why do people, first of all, we got to understand why do people leave their jobs. And, well, there's a lot of different reasons for that. But ultimately, we have several up here that I've talked to. And let me move up here so many, hopefully I'm not blocking many of you. If I am, sorry. But board challenge, relationship with coworkers, autonomy, independence, so on. What's the number one issue why people leave, though? Why do they quit? Not pay, actually. Not even flexibility. What's the number one issue? Not even that. Unappreciated, getting closer. They don't like their boss. Number one reason, always. They don't like their boss, don't like who they work for, and so they leave. So here's an important statistic. Write this down. The Census and Bureau of Labor Statistics said fully 95% of the hiring that was done in 2019 was done to fill existing positions. Not new created positions, existing positions. Why? Voluntary turnover. And furthermore, much of that came because people weren't even looking for a job, but somebody came and got them. We call that passive hiring. And so, well, what do we do then to address this? Why is there such a high rate of voluntary turnover and this passive hiring? Number one, start with looking at who's managing them. Start with the boss. Okay? That's a pretty good indicator of usually why, the top reason why pay, they may say pay and they may say the other things, but usually when you actually dig down in interviews and the research, that's usually 2 or 3 down the list. Furthermore, and this kind of substantiates what I'm talking about here in terms of why people leave or why we're seeing such high turnover. Employee engagement numbers are deplorable. Look, 68% of employees out there today, at least according to Gallup, are unengaged. 17% are actively disengaged. That means they're actually undermining the organization. So those are not good numbers. Well, furthermore, many business owners actually think about are worried about their folks being absent. How come they don't show up? Well, Mr. Business Owner, let me tell you, you got actually a bigger issue to worry about. That's actually costing you more money. It's presenteeism. What is presenteeism? You're actually physically there, but you're not really there. You're not really giving all that you could give. Yeah, you show up and give what you have to give, but not what you really could give. All right, so there's a gap there, and that's costing organizations, businesses, small businesses and large businesses, a fortune. All right, so let's look at the costs. These are real costs, folks. Forbes, 30, on a low, sort of more of a high turnover, low paying positions, 30 to 50% of their annual pay. That's what it's costing them. I'll get into what is contributing to those numbers. Up to 400% of their annual salary if you've got some higher level executives or management that are leaving. All right? There's a lot of different numbers out there tossed around, but ultimately, if I look at SHRM, Society of Human Resource Management, they're the industry de facto for the HR industry. They say replacement costs can be as high as 50 to 60%, with overall cost, meaning the total cost of 90 to 200% of their annual pay. It's costing, again, businesses a fortune. And this is something you need to be aware of, that you can be thinking about and noticing. We talked about state unemployment rate. Are you seeing that tick up a little bit? Or are you seeing more people, entering new people on the payroll and people jumping off the payroll? You can start looking for indicators, at least those in your profession. So let's peel back the onion a little bit. Where do these costs come from? Well, just think about all the administrative costs when somebody separates from the company. All right, got the exit interview. Maybe we're paying them a little severance pay, unemployment claims, removing them off the payroll, off the benefits. Getting somebody back on the payroll, on the benefits to replace them, COBRA administration. How about this, folks? Tribal knowledge. How much knowledge walks out the door with the folks that were in your business that is gone? You can't get back. It's very tough to get back. Or client relationships, vendor relationships, you name it. How about recruiting and training costs? Well, now you got to go through the whole process of recruiting somebody and filtering and going through the interviewing process and offering them maybe a signing bonus and then going through the whole onboarding. Well, guess who's doing your training? You want only your best people to be training the new employees, right? So now you're pulling them away from clients and from your own, maybe they're managers of other employees, so you're pulling away their time. There's a ramp up. But ultimately, your most valuable people, right? That's time away from employees, time away from customers. What about distraction costs? Many business owners don't even think about this. Okay? What happens when somebody leaves? A lot of the office talk, right? Why did they leave? What's going on? And then it starts from there, the impact to morale. Well, of course, then that may be a domino effect, right? Ultimately, hey, if Sally just left, maybe I should start. I don't know. She wasn't really happy, and I'm talking to her offline. Then they may start a little bit of a domino effect. And certainly then who picks up the workload that individual just had? Okay? Ultimately impacting the owner. Time away from clients, time away from the business growth. So why do they stay? Well, ultimately they stay for the opposite reasons that they left. Okay? But what's the number one reason why somebody stays? Right. They love their boss, the inspired leadership. Okay? And when we talk about inspiration is a little bit different than engagement. When I talk about, you can be engaged and happy and doing your work, but inspiration's like that next level. It's like, I love coming to work. I love doing what I do. I feel like I make a difference. In fact, the numbers out there show that somebody that's an inspired employee will contribute 27% more productivity to bottom line dollars to the business. Of course, again, they love challenge, growth, and autonomy and independence and values and company culture. All of this is important to a business. This is what the CEO, the owner of the business, needs to be focused on. How many of them are investing as much time? And think about your clients. Think about the companies you work with. How many are investing as much time in developing a great work environment, developing great employees and great managers as they are onboarding and rolling out the red carpet for new clients? I'll tell you, there's a great disparity actually here. If you think about the investment of time and resources, this is where they really, in a knowledge economy where talent is primo, this is where they really need to be thinking about focusing more of their direction and time. Again, a purposeful employee, somebody that's inspired, guess what? All the numbers add up. They're happier, they're more engaged, they're more productive, they're more efficient, they're less sick time out of the business. All right, how much time we got left, Joe? 5 minutes. Okay, I'm going to talk really briefly about millennials. Okay, probably a favorite topic of yours, and this is another complaint I always hear about. Dang millennials, won't work, lazy. Well, guess what? They always say this is the laziest generation, right? Is that what you hear? Well, didn't all the previous generations say that about the next generation, that they're the laziest generation? Well, the simple fact is, guess what? They're human beings, folks. And their motive, yeah, many of them want to become CEO in 12 months, and that's a little unrealistic, okay? We get that. But, they're in the tech generation, and they're driven by different things. They're not about experience they're not about achievement and making sure I get my 5-year pin and my 10-year pin and my 15-year pin because I stayed so long with the company. They're about the experience. Okay? This is the why leadership generation. They want to know, what are you about? They want a purpose-driven organization. They want to do something that counts, that has meaning. They want to make a difference in the world. That's what really motivates them. So if you don't seem like your millennials are really engaged and doing something, then you haven't really connected their role to a purpose. They're showing them that they're really making a contribution, a difference. They need trust. They need trust and room to run. You got to give them some flexibility, some autonomy, some independence to really show what they can do. Okay, micromanage them, and you're going to have a hard time keeping millennials. Of course, there's work-life balance. Many of you probably are familiar with that. All right, so that's just a few thoughts about millennials. And let me just wrap up with, okay, well, hey, I'm in the professional, I'm in the bookkeeping, accounting world. You're talking about all these turnover and costs, and what can I do? Like I said, folks, you are seen as trusted advisors, professionals, and you want to distinguish yourself as a professional, not only to external clients, but also within your organization. These are things that you can have the conversation about. Hey, just notice this, I'm noticing that. You might want to think about this is a real cost to the business. Be willing to have the conversation. Bring it up. They look to you as confidants, as people they can talk to, that you're handling financials of the organization. This is a real cost, okay? So you actually have the right, I think, to have this kind of conversation. And I hope you'll go there. Are they doing the fundamentals well? Okay, we talked about having a great work environment and having inspired managers and people, the reason why they want to come and stay to work. But these things are important too. Having good onboarding and orientation, reaffirming that, man, I made a great choice to work here. I'm so happy that the whole onboarding and orientation experience is not a miserable experience, but it really amps them up and they're excited to come to work. And you're really giving them a full, it's not just oh, okay, great to have you on the organization. Here's your desk. Talk to Sally if you have any questions, and have a nice day. Thanks for coming to work for us. That's what happens so many times, okay? Invest the time to really do a proper onboarding and orientation. Certainly in an employee handbook, set some expectations so they know what's expected of me. Here's how we do business here. Here's what our culture is. Here's what our values are, our principles. Here's what our purpose of the organization is, and some basic policy and procedures. Can't tell you how many employee handbooks are like I've got to ask clients to go dig them out and blow the dust off them if they have one. If they have, and if they do have one, many times they're outdated. Establishing just baseline expectations. What can you expect of me, and what can I expect of you? And here's how we're going to work together. And here's how you're going to be managed and rewarded, and performance management. Establishing an open coaching dialogue with them, that they can come to you anytime, open door policy, right? Having quarterly reviews. How's that for a novel idea? But actually sitting down with them and going, here, how are we doing? And how are things going? What can I do to help? Sharing with them some of how they're doing in terms of performance, and ultimately accountability. Folks, you can have a great impact in ultimately reducing the cost of turnover and helping your clients, helping your CEO owners fix this hiring conundrum, improving their retention rate, ultimately having a greater impact to the bottom line. With that, I'm finished.
All right, wow, what a great morning. I think we'll go ahead and wrap this up. One of the things that I enjoy the most about my position at RandA CPAs, working with the financial statements, working with the owners of the company, working with all the incredible team at RandA, is that we tell a story. We're not just bookkeepers, we're not just HR people, we're not just working in the business, putting numbers in boxes. We are helping to read, analyze, and provide feedback for a story that's written. And that story is about the health and happiness of an organization and the people inside of it. So hopefully you guys got a lot of messages this morning that resonated with you and your individual positions and your ability to impact and influence the businesses that you work with, for, and on. So thank you, everybody.